Jason is my name. I welcome to Property Investors webinar. We thought we'd do an end of financial year webinar, and obviously there's been some changes again from this federal government doing a little side deal with the Greens. So that's okay. That creates a window for everybody. And I was chatting with my team. I mean, I've been very, very busy. Must be everyone I've spoken to in the last 2 or 3 years that haven't gotten around or pushed off getting a self-managed super fund. Now all of a sudden, it's become obviously a very, very high priority. So we're going to talk about that today. Before we do though, it's obviously the last day of the financial year. And I just want to remind everyone of a couple of things if you haven't had advice from your accountant already. So if you've got at least one investment property in your own name and you're claiming the negative gearing, you're claiming the depreciation and whatnot, you can actually prepay expenses. So my understanding is, and this is without giving you tax advice, obviously there's something to ask your accountant today, is that you can actually prepay expenses up to 2 years. So if you've had a really good year, maybe you're self-employed, you've had a great year from a cash flow point of view, and you're looking to obviously defer some tax into the next coming years. With respect to your investment property, you can actually prepay expenses, all right? So whether that be interest or whether it be prepaying your real estate agent or whatever the case may be, and as a result, you might even be able to negotiate better rates for prepaying expenses and whatnot. So if that's relevant to you, get onto your accountant today, because obviously that's something that you can actually do today. All right, now that's not the crux of what I don't think that we should be talking about today. Today's really about self-managed super, and there's a restriction in terms of really what I can and can't say as well. But either way, there's obviously been some significant changes that have come through the government. Now, as I've said in the last few webinars, is that the change to capital gains tax hasn't affected our clients if they've got a property inside their self-managed super fund, because if they sold that self-managed super fund property, they would pay no capital gains tax and they could extinguish debt on the other ones and still obviously be sitting sweet. Because what changed was the 50% discount on the capital gains tax. And I've always thought, well, that's too much. But to now not get that 50% discount is definitely too much. And so that means that, the self-managed super fund property becomes really important, because that's the sacrificial lamb that we can pay, or so we can sell, pay no capital gains tax on, and use to extinguish debt on the existing properties. So that's obviously what can be utilized in those areas. So what I wanted to do is just to remind you of a couple of things, because I've noticed that those people that I've spoken to in the past that I've properly educated on this, they've gotten on the front foot and contacted me, and we've now motored through those meetings that are necessary to get to the stage where they're getting financial advice from the right people to go about setting up a self-managed super fund for them to then look at getting a property in that self-managed super fund. So the deadline, as you guys would know, that you can't borrow money inside your self-managed super fund anymore, which pretty much changes the playing field for virtually all of our clients, not everyone, but virtually everyone, because you really want to be borrowing money inside your self-managed super fund to leverage, right, to increase the size of the fund. So before we talk about sort of maybe what to do now, let's talk about sort of the transition to retirement strategy in a little bit more concrete detail so that you understand what that is. The 4 reasons for why you would consider getting a property inside your self-managed super fund without actually saying you should get it, all right? Because obviously there's a process you need to go through. This is obviously under the world of getting financial advice, and that's really not what we're here to do. We're here to obviously match properties that fit the criteria for a self-managed super fund, but I'm more than happy to share with you why you would consider it and why you would ask someone that's obviously qualified to talk to you about that. So the strategy that most of my clients that have a self-managed super fund property have is that the property inside the self-managed super fund is leveraged. So that means that there's a loan, right? So what's happening is that their contributions are actually coming into the fund. So let's say those contributions is $20,000 a year. That means that the 15% tax that they're paying is going to be about $3,000 a year that they're paying in contributions tax. So what that means is the contributions coming in, as soon as the contributions are paid by the employer to the super fund, the pooled super fund, they will then pay 15% to the ATO. So you never see that money again, and there's no way of getting it back. There's no such thing as a tax return, right, when you've got a pooled super fund. So you're basically losing $3,000. You're also paying fees inside that pooled super fund, right, as well. It's not like you're getting it all for free. And a lot of people have insurance, so they'll have total permanent disability and life cover as a standard. It won't be very good cover, and it'll be probably very expensive. So again, I'm not an insurance advisor, but from what I've witnessed over my whole career, that's what I've seen. And so I always call these pool super funds it's like the casino. The house always wins. They're getting top dollar premium for lowest cover, underwritten from whatever the insurer is. So there's that, as well as the fees that they charge and whatever performance that they have, which could be great, could be not so great. In my experience, it's usually average at best. But again, you can look at all those things in detail when you actually look at those funds. So that's not necessarily the reasons for why people consider getting a property inside their super fund. The first thing is that if you have, let's do an example. You've got $300,000 in super, and let's say you're getting a 5% return per year in that super fund, and property's getting 5% as well, then what you might look at doing is using, say, $200,000 of that $300,000 to put towards a deposit, pay the stamp duty, to set up the self-managed super fund, and then you're borrowing money inside that fund to buy, say, a $600,000 property. So you've utilized 200 out of the 300 to get a $600,000 property. So the bank's loaning 400, it'll be more than that because you've obviously got fees in there. But let's say you've got a $600,000 property, plus you've obviously got the 100 that's left over. So now you've actually got $700,000 in super that's getting a 5% return. So that's leverage, and that's probably the first thing that you would look at doing. That's the reason why you would borrow money to get a property inside your super. So that's the first thing. The second thing is the capital gains. Obviously, there's, if you're in retirement, transition to retirement, so you're 60 years and older. Again, you want to check this with your advisor, but my understanding is that if you sell that property when you're 60 and over, you'll pay no capital gains tax. So what you would do is you would have a principal and interest loan inside the super fund. There's no benefit to having an interest only loan because you don't have enough tax liability. Remember, if you're putting $20,000 contribution in, your tax is obviously $3,000. So it doesn't really justify having enormous amounts of tax credits. You want to have some in there. So having an interest only loan doesn't make a lot of sense. So you can actually be paying off that debt in your super fund, and by the time you get to retirement, you've got a property that's paid off or almost paid off. And that's obviously a massive bonus because you'll have some cash investments in your super through advice. You'll also have a property that's paid off or nearly paid off. And you've probably got some other investment properties in your own name where you've been using your income tax to obviously help fund those in interest only. So you have interest only loans. Your house should be paid off by that stage. And so now you've got a property that you can sell, pay no capital gains tax, and extinguish the debt on the other ones. And essentially that's a way to eliminate the debt so you can consolidate by selling that self-managed super fund. Really, really good strategy. And most of our clients, that's really the pathway that they've taken. So if you haven't got a self-managed super fund with a property in it, that's probably one of the reasons why you would consider it. And that's the reason why my phone's been going flat out for a week. So that's the first reason. Second reason, obviously, is the tax benefits of that $3,000 a year. For that example, is that you're claiming the tax benefits of the property, and so it would cost you about $3,000 to $4,000 to run the fund because you've got to pay for tax return, independent audit. You're probably paying advice, and you've got some ATO fees with 2 companies inside there as well. So there's $3,000 to $4,000 a year. But you're pretty much getting $3,000 back as tax credit. So that's kind of evening itself out. And remembering your pooled super fund, it's not like that didn't have any fees at all. So even if the fund doesn't make more money than the self-managed super fund in terms of return, which it probably will because you've got someone giving you advice, that's obviously pretty motivated by making sure that you get performance. Whereas, a pooled super fund doesn't sort of really motivated that much by performance because most people don't read the statement. I don't know about you guys, but in my experience, when I ask someone for their super statement, they know around about what their balance is. But when I say, what was your return last year? They don't know. What are your fees? They don't know. What's your insurance cover? They don't know. And the reason why I know that they don't look at their super statement that closely is that I can't tell you how many people, when I look at the insurance, and I'm talking to a married couple and I say, look, who's Fred and Mary? And they go, oh, that's my mum and dad. And it's like, well, that's who your beneficiaries are in case something happens to you. You haven't got your own wife and your children as your beneficiaries. So they're not even reading the statement. They're not reading it. And that's not a few. That's actually a lot of people are not reading the super statement because the psychology is it's so far away. They know the balance is getting up, but they're not seeing that the balance is going up because they've got a great, fantastic return coming in. It's because their contributions keep obviously bolstering it. So that's the psychology with most people. And when you're getting advice, in my experience, you'll likely probably get a better return because they're motivated by it. The advisor is actually motivated by that. Where it just feels like the whole industry's geared around the fact that not many people look at their statements. That's what it feels like. I mean, I can't prove that, of course, but it's just what it feels like. Anyway. So the other benefit is, so if you sell the property, you'll obviously get, the capital gains tax will obviously be a miss after the age of 60. You'll get the benefit of the contributions tax, and the last one, if you've got diversity. So after the global financial crisis, clients of mine that were in their late 50s and into their 60s at that time were really pissed because their super funds had halved because they pretty much were all in the stock market. And so eventually it came back, of course, because everything goes through cycles, but a lot of them couldn't retire when they planned to because the money wasn't there in their super fund. So in property, I'm not saying that property is always growing because it's not, but if you look at the median house price, it doesn't fall 40% or 50% like a stock market does in one go. It might fall 4.5% or 5% in terms of median house price. Now, that's not to say that there are different pockets in the market that will actually fall more than that, i.e. holiday apartments on Queensland coast, right? They might go down if there's an interest rate spike or if there's a recession because anything superfluous gets dumped. So that's why we stay way away from anything to do with lifestyle properties. And lifestyle properties, I'd also include luxury. So when you have a stock market crash and or recession, you'll find that anything lifestyle related in property will move down, but the median house price is pretty strong because people still need to live in that property. They might move into a cheaper property, but they still need to live somewhere. Even if interest rates are at 17%, they still need to live somewhere. So that's why we're always very conservative with obviously the type of properties that we source. So the fourth benefit, if you're investing in a self-managed super fund, is that you're minimizing your exposure to stock market crashes, right? Everything's cyclical. I don't know when there's going to be a crash. I've got no idea, but it's all about obviously managing the risk and managing the cycles, right? And in obviously doing so. So we don't give advice on this. I just know what the benefits are and why you consider it. And there's obviously a process that we go through where once you've had a chat with your consultant, they can actually then introduce you to someone that can give you that advice that also understands property. That's the key. Because if you just go and talk to, say, a financial planner, in my experience, there's a 99% chance they'll want to steer you away from investing in property because they don't make any money from it. That's just the commercial reality of it. They'll want to be getting your funds under their management, where they're getting a trail over a long period of time. So that obviously makes sense. So you've got to see what people's motives are. We've got financial planners that will obviously also look to try and do the finance for the property. So they've got a win inside the finance. And so they're comfortable in giving that advice in their statement of advice with property as part of the overall advice that they actually give. And so when they're giving a statement of advice, they'll be asking questions about your planning for a will, for example, and any kind of, any type of situations where you become medically incoherent and all that sort of stuff. So they'll go down that path. They'll look at all of your areas of risk. and then they'll assess to see, well, where's the best place, based on your risk profile for you to be investing, and that will obviously include property. And so we'll then provide obviously all that data to that person. They'll then provide us their statement of advice, and they can set up the self-managed super fund for you, organise the rollover to go in, and so you're controlling a self-managed super fund with that organisation. So there's a bank account that now all your contributions go into. You're not paying tax straight away. You're getting a tax return at the end of the year. There should be strong tax credits coming back because of what you can claim within the property. And so as a result of that, the cash flow is actually in your self-managed super fund bank account. And so that's where you have your contributions. That's where your rent goes. That's where you obviously pay the expenses of the property. And so whilst we call it self-managed, you're not really self-managing. I couldn't self-manage, within compliance myself. You really need someone that's qualified, that is obviously, doing all of the compliance elements of it, but obviously, working with you, right, to make sure that now all of those things are achieved. So they're the reasons why you consider it, and that's why I wanted to bring up today, because as you know, the deadline the government gave is the 1st of July, which is tomorrow. And by the way, the deadline is for the contract of sale of the property inside the super fund. So that means that you need to have found the property. You need to have the fund set up with, so there's two trusts, including a bear trust. So we won't get into the technicality of it. It's not my place to explain it anyway. But the point is that all needs to be set up for that contract to be raised. So to get a date on a contract, those things all need to be in place, which means that you have to have had a couple of meetings with that financial planner. And so the government had given a 45-day grace. So basically there's around about 6 weeks, about a month and a half, to get to a stage where you're signing a contract with the date within that grace period. All very, very doable, and that's why I'm having loads of conversations at the moment, and everyone is very conscious of time. So everyone's doing, round the clock hours to make sure that, obviously we're squeezing everything in and squeezing people in to make sure that everyone is comfortable with the advice that they're giving. And then we can sit down and say, right, now that we know all our numbers, and we can do a collection of, okay, what are your numbers compared to obviously all of our offerings from a property point of view, because the property has a little bit of superannuation. It has to be superannuation style property too. Can't be just anything. So that has to be a match as well. And so once we go through that whole process, then we have to make sure that we've got the contract raised and that there's contract date, right, for when that's actually signed. So that's what we've been spending a lot of our time doing. And I just wanted to remind everyone today, and with this recording that goes out today, that please reach out to your advisors. We are still working through properties that we've got frozen prices since the budget, right? So I think I mentioned to you that anything new, whether it be land or whether it be townhouses or apartments or construction on land of houses, everything has gone up in price because they're the markets that are obviously strong. It's not rocket science, right? The way that obviously all of this works. And what we'll be able to negotiate with our builders and developers is that anything that was already, that we'd negotiated to go onto our list, those prices would freeze, right? And so that's where we're still at. And so that's what I've got currently, clients that are benefiting from getting a self-managed super fund that was put on the back burner, now set up. And now we're going through a stage where they're also benefiting from, obviously the frozen price point since, obviously the budget came out. So that's about as much as I can say, and it's about as much as I will say. So please reach out to your consultant, your property investors consultant, who will actually be able to lead you through. They'll need to have a meeting with you to go through that process. My perspective is that I'd already had sort of a lot of those preemptive meetings with a lot of my clients in the past, or maybe people that haven't become a client yet. And that's why I've had a really, really busy week now seeing all of those people to actually set up the self-managed super fund. Probably the fifth reason that you might consider it, and my belief is, this is our collective belief as to what's really happened, is that people are pulling their money out of pooled super funds to put them into self-managed super funds. There's a real trend that's been happening, that's been increasingly getting high volume over the last few years. And my belief is that, this is an opportunity to actually stop that and to keep the money in the pooled funds. And so this is, a really good opportunity for you to get it out of the pool funds for a whole bunch of reasons, which I won't go into publicly, but if we have a chat one-on-one, I'll tell you what I really think. Other than that, have a look. If you've had a really good cash flow year, maybe you're self-employed or maybe you got a really big job promotion, you've got some cash in the bank, ring up your accountant today and see if it's worthwhile for you to prepay your property expenses, because you might get better rates and then you're also deferring your tax into the next 1 or 2 taxation years. Other than that, I hope everyone's well. We'll do this periodically now. As you all know, watch out for your emails. This recording will come out today.